to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Yeah, it's been very interesting. I hope everybody had a really happy new year. I've got Mike Seeger in the office here with me to do today's show. Welcome back to the show, Mike.
Yep, thanks for having me.
No problem. And Mike's actually the producer now of the Look Out for the Bull website, so we'll be talking about that in much more detail later in today's show. If you have a question for us, feel free to call 216-901-0945, 216-901-0945. And you can also go to my website. We've got a seminar coming up January 30th, and we're calling it the Question and Answer Seminar. And some of the questions we're going to talk about is the economy's on a roll, but how long will it last? You might have heard that manufacturing's been contracting, and it has been, large number of reasons, but a lot of the other economic activity has picked up to kind of stave that off somewhat, to kind of mute the impact. So we'll talk about that in a little more detail. Are interest rates ever going to go up? That's always kind of interesting. An awful lot of people would love to have if you had a 5% CD right now, if some bank had a 5% CD, or let's say all the banks had 5% CDs, that big sucking sound you're hearing outside all across the country is money coming out of the stock market and going back to a CD. That's all you would need to do, 5% CD. Yeah. Anyway, is that going to happen anytime soon? We don't think so. And I'll talk to you about why and what you may be able to do about it. We're going to look at various dividend income, equity income strategies that you might be able to use in the meantime. We're also going to talk about, is it possible today to minimize taxes without reducing your returns? In some cases, it is. There are a couple different items out there that are relatively new. There's an investment-only annuity that has super low expenses. It's really more like it's kind of like a non-qualified IRA, or where you don't get to deduct the contribution, but it's tax deferred. But this has no limit. So when you're doing the IRA, and if you don't qualify for the tax deduction, you can do an IRA a non-deductible IRA, but it's got a limit to the amount that you can put into it. Well, this is going to work very similarly, except that there are no limits, and the expense ratio is super low. This one's actually the lowest in the country right now, and you got huge funds available in there. We'll explain all that in great detail. We actually manage portfolios in that, so that's a nice thing to be looking at. One of the biggest differences between that and a bunch of the other annuities is that this has no sales charge in or out, meaning there are no penalties if you decided to change your mind. So that's a big deal. That's a really big deal. And in my mind, if you're going to get charged a penalty to take your money out, then I would probably avoid that. I would just, why? I mean, why would you do that if you could avoid it? And if you can reduce the expenses by 80 or 90%, that's probably a good thing.
I think so.
Yep. So anyway, we're also going to talk about I've been hearing market's going to crash. Market's not going to crash. And if it does, so what? It'll come back. Stocks are not overvalued. And every day when Mike's running the scans, and by the way, Mike's had to sit through all my boring training for hours on end. So I know he's very good at what he's doing, and living proof that it can be taught. Yeah, I was a little worried there at the beginning because a lot of people just never end up getting it. but Mike gets it. So I'm buying my stocks now in that portfolio from the list that he's publishing. So that's kind of neat.
Yeah, you exaggerate a little bit. It's only about half as bad as you say it is.
Okay.
But yeah, I'm running that now, and I'm very thankful that you taught me how to do that, and it's exciting.
Yeah, and it'll go through periods where it's super exciting, both directions. And you'll see. And, it's just realistically, it's kind of a quantitative approach. It's mostly math. And there's, I don't know, probably, there's actually a large percentage of your own work involved, because everybody, if you give the same list to 40 people, they're all going to pick different stocks out of that list. And whether or not they're super successful in the short run or in the long run is really a matter of luck. So it's just managing the risk. The same way with your portfolios, managing the risk. That's going to be part of our conversation. How do you minimize risk when the stock market's so volatile? The stock market's up and down a lot. By the way, the first thing you should do is probably turn off CNN or CNBC and try not to look at the headlines of even the Wall Street Journal, because these guys were talking about, they do this all the time. It just kills me that they're doing this. I know why they do it. They like to sensationalize everything. In fact, if you made the media today, the financial media, I think we should put them in charge of all these signs inside of an elevator. Okay? Because if you did that, the heart attacks in the country would drop precipitously. Why? Because the elevator would say soar and plunge, and more people would take the stairs. So if we're able to do that, because I'm so tired. They're talking, the stock market was up 32% last year. Yeah, but it was down 20% in December. It's not up a lot. Actually, if you go back to 2018, it's only up 12.5%. 2018, that's 2 years. Okay, so that's actually pretty good, by the way. The long-term average, around 10% or so. But actually, I take that back. That's half of the long-term average over the past little over 2 years. So that's one of the things that is just it just kind of gets under my skin. Should probably not let it do that. You'd think I'd be used to it by now, but I'm telling you, if you put the newspapers in charge of elevator signs, they would say soar and plunge. They wouldn't say up or down. They love to get reactions, and today it's necessary because you've got so many people competing for your attention. And you know as well as anybody, they get paid per views, paid per clicks. They know when you visit their website, they know which stories you're clicking on. The companies that put those stories out there are charging for that to give the position. And so it's really difficult, extremely difficult to get unbiased information. You really have to, everything you're looking at, you got to take with a grain of salt. And if you can't find several sources of data to back up whatever it is you're reading, I don't know. I would just excuse it. So anyway, back to kind of the topic. How do you minimize risk when the market's so volatile? And I'm going to come back to this. I can't believe, I would have thought, actually by now, I would have thought that I would not have had a job in the industry. I thought earlier on, people are certainly they're going to figure this out. And a couple things happened. Actually, markets don't behave the same way they did when I was new in the business. When I was brand new, you didn't have, the internet wasn't there. It didn't exist. So the only information you got was typically several weeks, maybe several months old by the time you got it. So you really had to study what you were doing. And it was actually a little bit easier because I would do searches, what you'd have to do by hand, by the way. You'd go through the Standard & Poor's books, and we all had analysts back in those days that worked for the firms that actually, some of them were pretty good. But you still wanted to know what they were talking about. So you had to study a little bit. But you could find stocks that were literally selling below the asset values of the companies. They call that book value. And there's another one called net asset value, which is a much stricter measure. You could find companies that were selling for the net asset value is basically an estimate of what they could get if they liquidated the company. Okay? So you could find companies selling below their net asset values, okay, and who were still making money. they weren't even losing money. And that was so easy. You just buy a bucket of those things, and sooner or later, if they didn't go out of business, which most of them wouldn't because, they had more cash than they had debt, something happened and the share price would go up, 100, 200, 300%. Yeah, that was pretty cool. Those days are over. Those days are gone a long time ago. That actually didn't even work that long because when I got into the industry, the internet was coming into being and information started being more available, not to the public, but to professional portfolio managers, and the mutual fund industry was growing like crazy. It was the ETF industry of its day. Mutual funds were coming out left and right. And they really had it was a big deal for, probably the first 10 years of my existence in the industry. And then they started coming out with exchange-traded funds who have much lower expense ratios and are clearly defined as to what they do. They're very clearly defined. Those are the two biggest differences. An actively managed fund is something that where a stock picker is going to go out and select stocks that they think have the most potential. And a big majority of those funds sooner or later are going to lag the S&P 500, sometimes for 3 or 4 years in a row. That does not mean that the fund's a bad fund. And that's part of the problem, I think, with investors is they don't know that. They don't know that Warren Buffett's underperformed the S&P multiple times in his career. And by the way, he's the greatest that's ever lived. So if you think you're going to do better than Warren Buffett,
good luck.
Yeah, good luck. But even Peter Lynch, same thing. And he was a portfolio manager for 13 years. I think 10,000 invested was right around 330,000 when he retired in just 13 years. Some people go, well, that doesn't sound like much. What? Really? So he had the greatest track record of any mutual fund manager that's ever lived. And but again, a lot of this stuff was before information flowed through to the other portfolio managers, not the public. The public has struggled, the vast majority of them, because it takes a long time just to learn how to read financial statements, and then the changes that come out all the time. They're just keeping up with that. The fact that the economy is a much different economy than it was back in those days. So a lot of changes to keep up with. And one of the developments I like a lot is the fact that the exchange-traded fund declares exactly what they're going to do with your money, for the most part. There are some actively managed ones. The guys were they're still trying to pick the stocks. That's fine. But the vast majority of them tell you exactly how they're managing the money. And that's a big deal because you can know, you have a better idea of what to expect. And it's that expectation that creates the stress on individual investors, at least my opinion, for a lot of it, because they have an expectation that's not based on knowledge of what is happening with the money. It's just basically looking at the past history and saying, oh, yeah, well, I like that. Well, yeah, see, that's kind of like driving home, looking in your rearview mirror at where you've just been. So instead of putting that solar shade, pulling that out of your window before you take off, you just leave it there. And you look in the rearview mirror and say, oh, if I just look at where I've been, that'll get me to where I want to go. Yeah, I wouldn't try that, by the way. Bad idea. But when it comes to investing, that is exactly what people do. They look at where that fund has been, not how it got there. And you've got to look out the front. You've got to see why it was successful and what kind of obstacles did they have to overcome. Same like with a car, if you're on a road and a bridge is out, you have to change your direction, unless you just want to crash. But most people don't want to do that. And I know that probably sounds kind of silly to an awful lot of people, but it's the real deal. And there are certain attributes that you're looking for. Like I started the show talking about the companies that were selling below their net current asset value. That is a mathematical formula. That's just a formula. And it happened to be a very successful one. In fact, Warren Buffett's mentor, Ben Graham, made back all the money he lost during the stock market crash by buying companies below their net current asset values. And when he retired, despite the fact that he lived through the Depression and invested money all the way through the Depression, his track record when he retired was 14.5% a year over his career. That's amazing. To be down 70% and then make all that back up and get your return up to where it's at 14, that's a big deal. That's a really big deal. So, like I said, you can still do that today. And one of the more popular ones, and ones I like a lot, are companies that they'll go out and invest in companies who are growing their dividends. The thing about growing your dividend is you have to be earning a profit to be able to pay a dividend, to maintain the dividend. You can pay a dividend without earning a profit, but eventually you're going to run out of money, and then you're going to be in big trouble. So if you're looking at a dividend that's actually been earned by a company who has been earning a certain rate of return on the money that's been entrusted to them, that can be a really good thing. That can be a really good portion of a portfolio. We have 3 different funds in our basic model that do that. They look at not only the companies that are paying dividends, but how are they paying them? Are they earning the dividend? If they're not earning the dividend, they're paying it out of the company's cash. Okay? And sooner or later, that cash is going away.
Yeah, it's dangerous.
Yep. So that's a big deal. We're going to, I'll touch on some of those things at the seminar. And that's one of the ways of kind of minimizing risk when you look at how the stocks are picked, how they're selected. It's a big deal. I'm going to tell you, most of the time, a market cap weighted index in an upward market, when the market's been going like last year was a very good year for market cap weighted funds. In fact, a lot of years are very good years for market cap weighted funds when they're going up. When they're going up, they tend to blister just about everything else at some point in time. And it's only when they're going down and they're blistering on their way down. If you look at September 19th of last fall, from September of 19th to, let's see what this day is here. Sorry about the delay there. So the low, sorry about this. I probably should have. Oh, nope. We're going to have to wait to talk about that, how fast that decline came, right after we come back from these commercial messages. You're listening to Bill and Mike right here on 1420. Stay tuned. We'll be right back.
Oh, what I would do to have the kind of faith it takes to climb out of this boat I'm in. Under the
And we're back, listening to Bill Bullington and Mike Seeger right here on 1420 The Answer. We're at this station every week from 11 to noon. You can also find this show at 955 The Fish's podcast, or you can go to my website if you wanted to download it. That's bullingtoncapital.com. And if you wanted to sign up for that seminar we have coming up, it is January 30th. It's at the Corporate College. It's right over off of Richmond Road in Warrensville Heights, right near Beechwood. It's a lot of fun. And we're going to be talking about... we're going to be doing questions and answers. And we're going to take a few minutes to talk about several topics: how to save money on taxes, what kinds of things you can do to try to get more income out of your portfolios without increasing your risk too much. We're going to talk about how strong the economy is or how weak it might be. And I always like to talk about developments that are happening that are going to push the economy forward. And there are just so many of them. I mean, I think it's probably appropriate that it's now 2020. It kind of reminds me of the Roaring '20s, because if you look back to that period, we just gotten out of World War I, but there were so many technologies that were really taking off. They had heavy equipment. Trains, by the way, had been around since the mid 1800s, but a lot of developments in the trains made them a lot more efficient. At the same time, you had the Industrial Revolution. Henry Ford started rolling off Model A's, and they were really cooking in the 1920s. and everybody else was copying that, trying to get that going. There was this little invention you may have heard of called radio that was also across the country and rolling out across the country. It was the internet of its day, and that created an awful lot of economic growth. And so you go back and you look at that time period and you go, wow, things were just really moving quickly. Now, it ended up where the stock market got overvalued. The economy slowed down. They used to be allowed to buy stock like you would buy a house. You would put 10% down, and you could borrow 90% from your brokerage firm. They don't allow that anymore.
I have a couple guesses why.
Yeah, that would be bad. Could you imagine? And by the way, the one-day correction, the crash of 1929 was only 11%. But when you're 10%, when you only have 10% equity, not only did you lose all your money, you owe 10% more than you had invested. So the chances of that happening again are nearly zero. The SEC didn't exist. The FDIC didn't exist. A bank could call your mortgage, and you had 30 days to come up with the money to pay your house off, or they would take it back from you. So there are just so many things, because that's exactly, whenever I bring this up, and this is kind of funny. To be a financial advisor, here's what you're asking for. You're going to bring up something that's a positive, and you're going to get probably half the people that you talk to that will throw every negative they can possibly think of, hoping that you'll be able to defend it and tell them why that's not going to happen. And that's exactly what it's like to be a financial advisor. I'm surprised more of them, don't have severe anxiety issues. But I'm sure a lot of them do. I know they do, actually. But sometimes I'm one of them. But the reality is, the economy is so strong right now, and there are so many different ways that it's growing. And I'm going to have to take a phone call, right? I've got Matt. Matt, you're on the Bullington Capital Report.
Hey, Bill. How you doing?
Good. How are you?
Good. Happy New Year.
Thanks. You too.
So I kind of just wanted to ask you, you're talking about the Roaring '20s, and I'm a student of history, and I love following all that kind of stuff. I started investing back in the '90s, and I went through the whole .com boom when you could throw a dart at the stock pages and you could make money. I watched the whole housing, bubble burst, the banking bubble burst.
Yep.
And, then things with commodities. And obviously, I understand things are, they're cyclical. There's different reasons things go up and down. But I guess my question is, because I know that the problems in the banking industry can kind of be core with any problem with investing. Do you feel like since 2007 and 2008 that they've kind of, and I've heard that they're kind of loosening up on their regulations, but do you feel like overall that something like that is not going to happen again? Like, even though they might get a little bit loose with some things, that they've really kind of managed what's going to happen with anything with the banking again? And
well, I think they're doing a much better job of managing that than they did before. It'll never be perfect, and that's actually a natural part of the cycle. At some point in time, banks lend too much money with too little down required and not enough margin on the upside. And where we get in trouble is when they lighten up on the restrictions of who they'll lend the money to. So if you're lending money to people who can't pay it back, that's a problem.
They were probably giving money to homeless people back then.
Yeah, right. I mean, you had they called them liar loans.
Right.
You'd call up the loan company that was online, and the person answering their phone was, "You do make $70,000 a year, don't you?" And people would go, "Well, no." And they say, "Let me say that again. You do make," and so people, "Oh yeah, I do." And they would actually, now that's a rumor. I don't know anybody that's actually done that, but
no, but you're right. And I work in the law enforcement field, and I literally watched that housing thing destroy, quality neighborhoods, inner ring suburbs, urban communities where they just destroyed it, and the pump and dump on those houses. And, obviously you blame people for, taking out loans that they weren't in a position to do, but obviously the banks had a big responsibility with that, and kind of giving money out to just about anybody,
right? Or
credit cards for that matter.
Yep. Yeah, credit cards are a little easier to get, but you're right. That was a problem. Before that, though, you had the Resolution Trust Corporation that was set up. The Congress funded it to pay back a bunch of the bad loans that were made in commercial real estate. That was early 90s. And what's wild is the number relative to the size of the economy at that time was actually larger. The losses were larger as a percentage of GDP than the 2006 bubble that burst that was in housing. The reason 2006 through 2009 was so difficult is because it might take 10 to 15 times the amount of paperwork to lose money on housing than it did on a commercial building. Does that make sense?
Yes.
Yes.
Yep.
So that was one of the other bad occurrences that happened. Even though the losses were smaller as a percentage of GDP, you had mountains of paperwork that people had to wade through to get that all fixed. And by the way, the thing that the Fed did in order to get us out of that mess, they forgave a lot of those loans. They printed up money. They rebuilt the financial system, and they got us back on track eventually. The net result of all that stuff is inflation. I don't know about you, but they're building houses all over the place, and starting costs $140 a square foot on your property.
Right.
That's crazy. I mean, but that's the way it is, and housing's still going pretty good. But my point is, the natural result of doing all this stuff is inflation, and that's why it's so important, especially today, to have a well-balanced portfolio, because a bond portfolio is not going to keep up with inflation, especially when you start taxing it. You add inflation and taxes together, and those CDs that people have are losing money every year. They're becoming worth less and less, even after the interest that they get, because the purchasing power goes away. So that
right. I mean, I remember getting CDs back in the 90s where I was paying 5%, and then talking to people back in the late 70s and 80s when interest rates were up, and you could get CDs, I believe, up to like 10, 12% for...
Some of them were 15 for 20 years.
Wow.
Yeah.
Right.
That's nuts.
And so I guess kind of obviously watching, the stock market be artificially inflated in the late 90s, the housing market being artificially inflated, do you feel like things have kind of settled where growth is kind of back to the norm, or do you see another bubble on the horizon with stuff?
Well, right now, if you look at, and there's a good way of kind of measuring how far away the market is from what would be considered to be normal. That's always shifting a little bit, by the way. But so if you look at price to sales ratios and you look at average profit margins, that's something I'll probably touch a little bit on in the seminar. It kind of gets pretty deep in the weeds, and I end up losing a lot of people. But if you look at where it is right now, it's right around normal. It's right around normal. So that's why I'm excited about the opportunities today. We're kind of similar to where we were in 1996. That led to 3 years of super growth. I hope that doesn't happen again. I hope we don't have 3 or 4 years back to back of 30% growth in the stock market, because the market's going to be overpriced and everybody is going to want in at the wrong time.
Yeah.
So I'm hoping that doesn't come back. And it doesn't look... Every time you make those mistakes, by the way, and especially in America, any country in the world that's got some relatively intelligent people in it, they look at the mistakes and then they say, you know what, maybe we shouldn't do that again.
Right.
Or maybe next time we'll try something different. And so we learn by experience. And experience is a great teacher, but I'm always happier when it's somebody else's experience that I'm learning from than having to go through
that's the problem. Right. The problem, though, is people say, well, next time will be different. Next time. But I do truly feel like it seems like things have settled, and like growth is normal, like inflation grows at a normal rate, interest rates are growing at a normal rate, which is what I think most people are willing to accept.
Yeah, I agree with you. It's much more, everything is close to normal right now, which is good. That's awesome, especially when you still have GDP growth. That's excellent, especially when you have other industries that are brand new. This whole 5G thing, everybody thinks it's just your phone and your cable. It was built for driverless cars. That's what the technology was intended for. Then they realized that if they put the network all the way out across the country, that you can do what I do. I watch YouTube television. I have a cable subscription, but it only does internet. And so I pay Google $50 a month for YouTube television. I've got more channels than I can ever watch. Unlimited DVR time. They'll copy anything. There are tons of movies on there that are free. So my total expenses on my cable bill are relatively small. They're under $100 a month. And I have better services than a lot of people who are paying 2 or 3 times what I'm paying. Now,
well, and that's something I know I'm dealing with. And that's an industry I see where I wonder if they're going to be phased out, the cable industry.
Oh, well, what'll happen is, and they're trying to make the transition, they're going to transition over to 5G. They'll still provide services. They're just going to provide it wirelessly instead of having to have all that fiber optic running to your house. It'll actually, in the long run, it'll be better for them. It'll be more cost effective. It's a little bit easier to repair because the networks are these transceivers are incredibly small. The big money is spent on the development, research and development costs. The actual manufacturing of them is not very expensive. So they can roll those out pretty quickly once they've captured back the cost of developing the technology. It's cool. And from what I understand, the chips are reprogrammable. So instead of having to put new antennas, new transceivers up, I don't know if you ever see the cell phone towers, they got all this stuff stapled on them. Every time the technology improves, they got to go out to those towers and add the extra stuff on there. By the way, don't try to use your cell phone near Rockside Road on 77 because it's going out.
Good to know.
Yeah.
Well, I'm going to excuse myself, Bill, but it's always good to listen to your radio station.
Oh, thanks for calling, Matt.
New Year.
Thanks.
Okay,
you too. Bye-bye. Yeah, so I guess I will. We're coming close to a commercial break here, and then when we come back, we'll talk a little bit about the last scan that Mike sent out for the Lookout for the Bull website, and some of the stocks that are showing up there because it's interesting. But yeah, what he was talking about, things are really close to normal, extremely close to normal. That makes me feel great, especially when you have a lot of things happening that are should lead to further growth. That 5G thing is not just computers. I mean, it's everything. It's toys. It's those ring things where you see the guy looking on his phone and looking out at his house. Well, that enables you to do that with literally almost no lag. It just goes so far. Artificial intelligence. They're going to be listening to you. See, that's kind of wild. They're doing it now, but you're going to feel like they're reading your mind, but you won't realize that it was because you were talking about something to somebody in your house.
It's a little bit now, but it's going to get bigger.
Yeah, it's going to get bigger. So, actually, this might be a Shark Tank thing. Let's build a room or just a little structure that you could set up. Maybe you could unfold it. It's like a box that you can get inside in your house and talk that blocks all the signals so that you can talk to somebody. I'm not sure that would be a big seller, but anyway, I hear the music. That means we've got to take a real quick commercial break. You're listening to Bill Bullington and Mike Seeger right here on 1420. Stay tuned because we'll be right back.
On a Sunday evening, I'm looking back over all the years.
And we're back here with Mike Seeger and Bill Bullington. We're here every Saturday morning, at least I am, Mike is the producer. I trained him myself. We talk every day. He's actually running the scans for the Lookout for the Bull website, which I think is awesome. And he has got a really good understanding of it. And so I thought we would talk a little bit about some of the companies that are coming up in there. One of the companies that came up on the scan was a company called AeroVironment. And AeroVironment, I've been in and out of that stock over the years. They do a lot of stuff. Actually, it's amazing how much that company has changed since the first time I started looking at it. In fact, if I'm not mistaken, I think that they had a charging systems for lithium-ion batteries. That was a part of the business, and I think that might have gotten spun off.
Interesting, because today they're all about drones, right?
Yep. Yeah. And so they do almost exclusively that stuff. So I could be wrong because I've been doing this for so long. Sometimes it's just that's the way it goes. But yeah, they do mostly drones. If you want to go to their website, avinc.com, it's a company called AeroVironment. And the only reason I bring this up is because it has a classic looking breakout on its chart. It's classic. It's selling at 4 times revenues. That's not cheap. That's not cheap at all. But a company like that, their sales and profits can fluctuate wildly. And oftentimes the share price will go up in advance. So that's why I learned to look at the share price movement instead of just the financial statements, because there are people who are really close to the situation that are investing, that understand what the product lines are and that are changing and what the potential might be for that. And they will run that share price up in advance. So you want to kind of take a look at that. And when that one came up, I was just brought back a lot of memories, and that's actually why I talked about it. And it's got a really nice looking chart. And it was up 6% on Friday. It closed right near the high of the day. The volume was above average. And over the past 3 months, it's in the top 10% of all stocks. So it's got, the odds are actually in its favor now. Okay. Even with a price to sales ratio of 4, that's really not that bad for the type of company that is. A little high if they were producing soap, but their products tend to be very expensive, and the big buyer of theirs is the military, and we all know the military is really frugal, right? No, I'm just kidding. But I'm sure the buyers do as good a job as they possibly can there. But so anyway, if you wanted to check that out, the stock symbol is AVAV, and that would be one of the recommendations that comes out on the list that you're running every day. I just had I was just curious. What's your overall opinion of this stuff relative to what it was before you started?
You talking about the momentum scan specifically, or? Yeah,
in investing just in general.
Oh, well, so before I ever interned with you about a year and a half ago, my understanding of the stock market was very simple. It was very pedestrian, I would say. So a lot of the things I stuck to is, buy and hold, buy low, sell high. That was kind of my understanding. And I think there are 2 or 3 lessons that are very simple. Obviously, it's more complicated than that, but there's 2 or 3 lessons that you've kind of taught me that I think really stuck with me. The whole idea of controlling your risk, regardless of what you're buying, putting stops, using your 1% rule, that sort of thing. It never would have occurred to me beforehand to run it that way. So that was really, really interesting to me. I guess if I could sum it all up, I'd say that there are very smart ways to do this, and I was under the impression that it was much more luck based.
Right.
So if you follow the rules, it makes a lot of sense.
Right.
I guess that's what I'm trying to say.
Yeah. And one of my reasons for putting this website up is because I used to do this for, actually it was 50% of the money that I managed. I used to use these exact parameters. I had to stop, a couple reasons. The speed is way faster than it was back when I was doing this. And it was pretty quick back then. But now it is just mind-boggling how fast these stocks can go up and down. Okay, so, and I have a much larger client base, so it's almost impossible. And to to top this all off, this is something that you do because you really like doing it, that you enjoy it. It's a hobby that can make you money. Most hobbies cost you a lot of money, especially if any women are involved. Just kidding. But anyway, this is a hobby that can make you money. It's fun to talk about. It gives you a much better insight into how stocks really work and how they behave. So, and that's what I really like about it. It's an educational tool, and it'll just open your eyes. And then when you start listening to some of the other things that I'm saying, like having a plan, every ETF, the prospectus is its plan. They're telling you what its plan is ahead of time. So if you understand and can recognize those characteristics, say like profitability, that's always a good thing. Yeah, you go, oh, okay, I get that. And you become comfortable with your investments. And comfort is kind of a key. You need to be comfortable with what you're doing, but only if you want to be successful. Mm-hmm. If you want to join the average investor, who, by the way, over the past 20 years, while the S&P's averaged, about almost 8% a year, they've averaged under 2%. Oof. Okay. If you want to do better than that,
I do.
Yeah. Then it's really a good thing to understand all this stuff. And one last thing I did want to touch on. It's kind of like that 1% rule when you're buying, as your account grows, the a percentage that you're going to invest is going to be larger because the account's bigger. Mm-hmm. Okay? As you count, when you go through a losing period, your next transaction is actually going to be a little bit smaller because it's based on the account size, not on a dollar amount.
Right, it's that percentage.
Yes, that is a huge deal. That has an enormous impact on how well you're going to do. And again, we'll talk about that at that seminar that's coming up. And I'll talk about this all the time. It's kind of like working with my dad. My dad was a carpenter, and we did a lot of remodeling. And I was always amazed that we could go into these old neighborhoods around Cleveland, been built in the early 1900s, and we could take a house and we could make it look brand new. And what really cracked me up is when the house would be leaning. The house is leaning, but if you put the siding on straight and level, and then you adjust the windows, put new windows in the house, you actually have to shim them up. You're putting those straight, so the house actually looks straight. You can fix a leaning house and make it look straight. So that kind of stuff, I just thought it was magic. We go in and you put new drywall in. You have to tear out all that old lath, but that stuff. You know what lath is? There's strips of wood, and then you used to put plaster on top of it. They didn't have drywall back in those really early days. Nasty. But we would tear that out, put up the new stuff, get it taped, painted, and the house just looked brand new. So I was always amazed by that. So that also is in my blood. I love my favorite television channel, HDTV. And I was so thankful when YouTube television added that. So I was missing it from before. But now all these television stations are going to be streaming. So anyway, what was interesting, I just ran the scan myself, and I'm looking at some of the other names. Some of these I already own because they've been coming up, and that's what you'll find as well. Stock will show up several times.
Yeah, a couple of them showed up in the past 2 or 3 days. I know Trepanion was one of them.
Right. Trepanion, by the way, is I only know this because I've been looking it up. They do insurance for pets.
Interesting.
Yep. So I was like, people love their pets. Mm-hmm. I mean, they really love their pets. I get it. But I thought it was kind of interesting. Now, and this is one where the Trepanion, reason I haven't owned it actually, is that the average price to sales ratio for an insurance company is typically between 1 and 1.5. Okay. Its price to sales ratio is 2.46. So I'm not all that enthused to be paying a much higher price for it. Although, it'll probably go up and double now because I said that. And that's the other thing that you'll learn is to develop a sense of humor. You'll be laughing at yourself mostly. That's hard for some people to learn how to do. But if you stick with it long enough, you'll have no choice. That's just kind of how that whole thing works. But anyway, so if you'd like to come, and I'll actually be showing the website and going through that stuff at that question and answer seminar, because I think it's a really good thing to do. And like I said, there are funds that are doing stuff that is, you're splitting hairs. They're very similar. If this kind of stuff sounds good to you, you're young, you want a momentum. That's what they typically refer to it as, momentum investment model. There's several out there, and they're very good. And the chances of you actually beating them are pretty remote. The chances of me beating them, pretty remote. I only do it because I like doing it. And I've got a very small percentage of my money in there. It's probably large to a lot of people, but it's a small percentage of my total. So, yeah, that's a big deal. Now that I hear the music, I guess they're kicking us out of here. Hey, Mike, thanks for coming. Again, Mike Seeger, the editor of Look Out for the Bull, and I'm Bill Bullington, president of Bullington Capital Management. Thanks for listening today. Have a good week, good investing, and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.